Welcome back, and today we are examining Chapter 11, which is dealing with the long-term tangible and intangible assets. These include property, plant, and equipment. There are 8 learning objectives in this chapter. Let's start by identifying the types of property, plant, and equipment, and look at the initial measurement of each, applying the definition of an asset to the decision to expense or capitalize other expenditures associated with these assets. There are 3 necessary characteristics for property, plant, and equipment. The asset, first of all, must be tangible. That means you can actually see it, touch it, smell it, feel it, hear it. Secondly, the asset is expected to be used by for more than 1 year, or for more than one operating cycle. This makes it long-term rather than short-term. And the asset should be used in the production of other assets, which will be sold or for rental or for administrative purposes. There are various types of property, plant, and equipment and buildings. These are the general 3 categories. Acquisition costs are the costs included or necessary to bring the asset to the location and put it in condition to make it available for use. If an expenditure is not necessary to bring the asset to the location, the firm should include the expenditure, those expenditures in expenses. Firms can capitalize interest as a part of the acquisition cost on the assets constructed or otherwise produced for the firm's own use. The amount of interest that can be capitalized is based on the weighted average accumulated expenditures for the accounting period. There are 2 interest rates that are used in determining the amount of interest to capitalize. Number 1, for specific borrowings, the interest rate incurred or specified in the borrowing. For general debt, the weighted average of other outstanding debt during the purchase period applies to the amount of weighted average accumulated expenditure that is greater than the amount borrowed specifically to finance the construction of the asset. Here we're talking of buildings principally. Interest costs can be capitalized from the time of the initial expenditure to the time the asset is ready for its intended use. Any financing after that is treated as a financing expenditure, and the interest is not capitalized, it is expensed. Learning objective number 2, how do we account for depreciation for our long-term assets? Remember what depreciation is. It's a systematic allocation of the cost of a long-term asset to expense over the asset's expected useful life. That is, depreciation is an expense, but it's an estimated expense and subject to revision as time proves that our estimates were off. There are 3 basic methods of depreciation allowed under the generally accepted accounting principles. The first is called simple straight line, where we take the number of years of useful life and divide the expenses into equal allocations, 1 each year. The second is units of output, where we make an estimate of how many units of output the asset will be useful for, and then to accumulate depreciation and record it as expense as those units are produced. So it would be proportional to the units of production that the asset is used for. And finally, we have what is called double declining balance. Very often an asset is worth more in the early years than in the later years. And to recognize that, we take larger depreciation in the early years, lesser depreciation in the later years. The formula is provided for you in the chapter, but it is called double declining balance, which is a heavier depreciation in the early years during the more productive life of the asset, presumably. Learning objective number 3 is to determine and illustrate the appropriate accounting for derecognition of these types of assets. Derecognition means simply that we sell them or abandon them. In doing so, we take them off the books. And how is that done? Well, if the asset is properly expensed, that is depreciated and valued, we don't have to record anything extra. But if, as typically, there is either a residual value or a lack of a residual value that we've been counting on, we record either a loss or a gain as part of the derecognition process. Learning objective number 4, what are the disclosures that are necessary for these types of assets in the footnotes on the financial reports? Common disclosures include at least these 4. Balances of depreciable assets by major classes at the end of the fiscal year. Secondly, accumulated depreciation on property, plant, and equipment at the end of the year. Number 3, a general description of the method or methods the firm used in computing the depreciation. And number 4, the amount of depreciation expense for the period as a total. Learning objective number 5 is to specify the characteristics and types of intangible assets. As opposed to tangible assets, intangibles are ideas, concepts. They don't have a physical existence in the proper sense. They include things like trademarks, patents, copyrights, trade names, etc. In measuring these, it depends on how the firm acquired the asset, and we also recognize there are 2 types, those of determinate length and those of indeterminate length. Presumably some assets can last as long as the corporation, that is, they don't expire. Others do have an expiration date. A good example would be a trademark, not a trademark, a patent. Patent confers the exclusive right to manufacture and sell a product for a limited period of time, eventually expiring. After acquiring these intangible assets, they are subject to amortization, which is similar to depreciation on a tangible asset. The most common amortization method is straight line, so we simply record the expiration of the intangible over time in a straight line method. Companies recognize then a gain or a loss in the income statement upon disposal of the intangible asset or expiration of the intangible asset. The gain or loss is measured as the difference between sales proceeds received and the carrying value of the asset. As you look to the chapter, you'll see how these recordings are debited and credited appropriately. And finally, detailed disclosures for intangible assets include at least the following 7. The amounts of indefinite and finite life intangible assets. For intangible assets subject to amortization, the average amortization period in total and by major class. Number 3, the carrying amount in total and for each major class at the beginning and end of each period. Number 4, the aggregate amortization expense for the current period, as well as estimated aggregate amortization for each of the next 5 years. Number 5, changes in the carrying amount of goodwill, including goodwill acquired, goodwill impaired, and goodwill that was included in a disposal. By the way, goodwill, since we bring this up at this point, is one of the most difficult intangible assets to account for, let alone to measure or describe. But goodwill represents competitive advantage that a firm has over other like firms because of its reputation, efficiencies, management. There's a number of reasons one might record an exceptional value to a firm, and that would be recorded in an account called goodwill. A good example of that is the McDonald's Corporation. McDonald's believes that their trade name their symbols, their copyrighted symbols, represent goodwill, and that McDonald's has goodwill from the public because it is well known, well liked, and well respected. And so they have recorded goodwill as the sum total of all advertising since the very first day. And that means they just add up each year's advertising into the goodwill account to account for the extra value that McDonald's Corporation may have over and above any other similar type of operation. Moving on, number 6 and 7, disclosures. Accumulated amortization in total should be recorded, and amortization methods used for finite life intangible assets. And that concludes Chapter 11. We will continue on next week with Chapter 12.